Great, thanks, Clive, and welcome today. Coming to you from very wet Sydney. It's absolutely pouring rain outside, and so I'm not going out for lunch today. I'm going to have lunch at my desk. um, so I'm just going to spend the next sort of 5 or 10 minutes just to give you a little bit of a background as to how we're seeing markets at the moment, a bit of a view of the reopening trade, if you like, and probably really importantly to start talking about long-term interest rates because that's clearly where the market is focused at the moment. So I'll just start with, I suppose, the news overnight that the Biden administration is looking to kick off a $3 trillion infrastructure package just on the heels of their $1.9 trillion COVID-19 package. To put these numbers into context, the US is a $20 trillion GDP economy. So obviously $4.9 trillion is 25% of GDP. It's an unheard of amount of government spending outside a wartime environment. So that's probably a good point to start. So the Bank of England was founded in 1695, and they have records of that economy going back that far. Obviously, the United States became a country in about 100 years after that. So we've got fiscal records of those two big economies going back that far. And the only time you find this level of government spending is the Napoleonic War, the US Civil War, World War One, and World War Two. So this would be the fifth time in history that we've seen this sort of government spending and debt to GDP levels, which were over 200% in the early 1800s when the Napoleonic Wars were being fought, and well over 100% again during World War One and World War Two. So we're with the amount of government spending and debt that's being taken on by governments at the moment, we're getting back into those sorts of territories. So I think it's a very good history lesson to go back and look at what happened after the war was won. So if we can maybe slightly prematurely say the war against COVID-19 has been won because we have a vaccine, obviously there's variants and there's also different efficacy levels amongst different vaccines. So it's probably going to take a little bit longer and be less of a sweeping victory than we otherwise thought. Notwithstanding that, it does look like most of the population is going to get vaccinated and will win this war. So what happens now? We have a massive amount of debt and we have massive government spending. The government spending is going to go away, and then we're left with a fiscal cliff. And obviously the first part of that's the labour market. So there's around about 900,000 people in Australia still getting JobKeeper, and there's about 5 million people out of work in the US who had a job pre-COVID. So there's still a big gap in the labour market that the government's filling. And so as they roll off this, but the concern then is, okay, we're left with all this debt, we need to pay it off. So how are governments going to raise enough cash to pay off this debt? And the logical solution that a lot of people arrive at is they're going to tax their way out of the problem. So obviously Biden's already said he's going to reverse some of the corporate tax rates, but history doesn't suggest that's what happens. What history suggests happens is that the central banks have an agreement, if not a written one, then a verbal one, to keep interest rates low for a very long period of time to allow the governments to grow their way out of the debt problem. So you do that by causing inflation, and you do that by letting the economy run very hot, and the growth in the economy grows tax receipts, etc., and it reduces the amount of unemployment benefits, etc., so the government can run a surplus, not having to pay a lot of interest as well, because if interest rates are low, they don't have to pay interest on the debt, and that's the way they get out of the problem. Now, that's what's happened every time we've had this scenario in the past. Now, obviously, we've had to reach back a long way into history for precedents, and how much of a precedent is what happened in 1800 to what's happening today. I mean, arguably, it's quite a different environment we're in today. But I think there's some lessons in there for investors that are worried about interest rates shooting up anytime soon. The reality is that it actually makes a lot of sense to have inflation, a lot of sense to have very strong economic growth, and very, very low interest rates. So that's a big departure from why central banks were set up in the first place, which was to control inflation, not to create it. So these organizations are set up to control inflation, and yet they're being used to stimulate inflation. So for investors, that's very good news. For savers, it's very bad news. So there is a massive amount of saving that's gone on in the last 12 months around the world. So what typically happens in recessions is people run down their savings. They lose their job, and so they eat into their bank deposits, and that's typically what happens during a recession. During this downturn, the savings rate has gone absolutely berserk. It's been over 20% in both the US and Australia. And China, which normally saves 30% of its income as savings, has reached almost 40% level of savings. So there's hundreds of billions of dollars more in bank accounts today than there was a year ago in Australia, and you can multiply that around the world. So there's massive pent-up demand that we don't typically get in recessions. In recessions, demand gets destroyed and then slowly creeps back. Because of all this cash that's sitting on the sidelines, there's a turbocharge in the economy. Now, that started to show up in the labour market in Australia. It hasn't shown up in a lot of other places because they're still dealing with COVID. We've sort of dealt with COVID, so we're now returning to work in record numbers. So the labour data that was out last week is a very good indication that the Australian economy is recovering really, really fast, which is fantastic news because, as I said, we've still got about 1 million people on JobKeeper. But as that labour market recovers strongly, and that's without us opening our borders, those people should get back to work pretty quickly. So we're in a scenario where interest rates are going to be 0 for 3 years. Most of the central banks have said that, and yet we're going to have very strong economic growth. So it's a real push and pull in the markets between the bond market, which is starting to price in higher inflation, and overnight US 10-year inflation expectations went up to 2.3%. That's the highest they've been for a while, and they've been going up pretty much in a straight line. And on the one side, you've got higher bond yields responding to those higher inflation expectations. On the other side, you've got very strong earnings growth. So I'm sure the companies that are talking to you today are experiencing a pickup in their business, and they're probably looking forward to the future with a high degree of optimism that their products and services will continue to grow going forward. So I think it's a very good time to be a growth investor, but there are going to be speed wobbles along the way because as the long-term bond yield starts to price in higher inflation expectations, you will get a softening in PE ratio. So we've already seen that. The PE of the Aussie market's gone from 22 to 17, but at the same time, the earnings are growing. So I think the key in this market is not necessarily to worry too much about the bond market. It's to make sure that you're focusing on growing your revenue and growing your earnings per share, and that will sort of take care of it. So we're still positive the Aussie market, and we're probably favouring small companies over large companies because they've got stronger growth dynamics. So with that, I'll pass it back to you, Clive.